Hello everyone, this is Manish Chauhan from jagoinvestor.com, and today I'm going to talk about the most favorite product of most of the Indians, which is fixed deposits. In this video, my focus is to make you understand why you should rethink about investing in fixed deposit for a very long time, why you should break your attachment with fixed deposit and reconsider your relationship with fixed deposits. Now, before I get into that, I want to first talk about why people invest in fixed deposit, why they love it so much. So the main reason is, they are safe, they are simple, and there is no hassle with fixed deposit. It's we are conditioned to invest in fixed deposits from our childhood. So our parents, our relatives, everyone talking about fixed deposits. All the time we hear about PPF, fixed deposits, safe instruments. We are conditioned to think that we should always invest in a safe product, bank fixed deposit, or even for that matter, company fixed deposit as a safe. Our money is not at risk. Will earn a safe interest, and that is how life should be. And there is nothing wrong about it. I mean, it's okay to invest in fixed deposit, but in certain cases, and I'll talk about that. So let's first understand what are the problems with fixed deposits. Now, let me first raise the point of returns. Now, in today's environment, what is the return you are getting in fixed deposits? You are getting like 7%, 7.5%. That's on the higher side. Maximum 8%, let's say. What is the inflation? Inflation is lying around 8 to 10%, right? Every year, things are getting costly by 8 to 10%, and this is not happening just for 1 year. It is happening from years and years. Just look at the expenses, how it has risen in the last 7 to 8 years. What were expenses like 15 years back, 5 years back, 10 years back, and what it is today? So things are rising in prices dramatically. Okay, so you are earning 7 to 8% in fixed deposits, and the inflation is at like 8 to 10%. So what are you getting eventually? Your 100 rupees becomes 108, and something which was at 100 rupees, it was costing you 100 rupees, it is now at 110 rupees. You can't even buy that. Your purchasing power has gone down. So in your head you feel, okay, my money has grown, my 1 lakh rupees has become 1,08,000. I have actually got the money, but somewhere you have actually lost the money, and we don't think it like that. We don't think this way. Now, for 1 year, if this happens, it's fine, like not a big deal. But think about it from a 10 years, 20 years, 30 years point of view. If this compounds, if it keeps on happening to your money is just growing in numbers, but not in purchasing power. And that's a big issue. Think about it. You will not get it in the first way, I think. But if you think about it, do the numbers, see what has happened in last 5 years, 10 years, and you will realize that your money is on a slow poison, I would say. I would like to term it that way. So that is the first reason. The second reason is the taxation part. Your fixed deposit returns are not optimized for taxation. Like whatever you earn, and if you are in like 30% bracket, straight away you pay 30% of those returns. First, the returns are not that great, and on top of it you pay the tax. So the post-tax returns from fixed deposits are not that great. Okay, so now you will say, okay, Manish, like I will not invest in fixed deposit, but what about the alternative? What is the alternative? So I'll talk about two things here. The first is for the person who says that I will not invest in fixed deposit, but tell me some alternative which is safe, which is secure. I do not want to lose my money. For them, I would say the alternative is debt mutual fund. Okay, these are the mutual funds which are very much like fixed deposits. They are safe, secure. They give you very high level of security. They invest in government bonds, high level like certificate of deposits. There are many companies which float fixed deposit. They invest in that. So these debt mutual funds are very much secure and just like fixed deposits. There are two advantages of it. The first is that the returns you get out of it is much better than fixed deposits. And when I say much better, I mean it can range up to 1.5 to 2% higher than traditional fixed deposits. And the second advantage is that the taxation on these debt mutual funds is good. Like in fixed deposit, what happens, you pay the taxation, the tax every year, even though you have not earned it, even though it has not come into your bank account, you have to calculate and pay the tax on it. But in debt mutual fund, what happens is you can defer the taxation part. So if you are investing in 2016 and you have invested for next, let's say 10 years up to 2026, there's no taxation conversation in between. It will come only when you sell the funds. Okay, and even at that time the taxation is much better. It is like not 30%. I'll not go into taxation part, but it is more optimized compared to a fixed deposit. So you can earn anywhere from like 1.5 to 1.8 times, I would say, compared to your fixed deposits when you are investing for a 10-year period. So if you invest 1 lakh rupees in a traditional fixed deposit, and let's say you earn X rupees at the end, in case of debt mutual funds you can earn anywhere from 1.5x to 2x. Just think about it, your wealth is getting doubled in debt mutual funds, and the risk level is almost same, I would say. Okay, the volatility is very, very low. Just search about it and read about it more. The second alternative is for a person who can take a little bit risk and they are ready to see the volatility in their money. And for those people, I would recommend equity mutual funds. Now, equity mutual funds are linked to stock market. I know that stock market, when you hear the stock market, you feel like, oh my God, my money is at risk, it will go down. But it's not like that. Over a long-term period like 10 years, 20 years, 30 years, the returns from equity mutual funds or even direct stocks are very high. They're highly safe in long terms, not in short term. So if your main target is to create wealth for you for 10 years, 13 years, 15 years, 20 years, equity mutual funds are suggested products for you. I would say you can still look at fixed deposits, but only when you are looking for parking your money for let's say 1 year or 1.5 year, 2 years, when your focus is not on your returns but simplicity and just the liquidity of the money. If that is your main focus, I would say still you can look at traditional fixed deposit, but still I would say why even then, you can still invest in debt fund or liquid fund and you can get out of your money in 1 or 2 days or 3 or 4 days maximum. So think about it, think about mutual funds, either debt mutual funds or equity mutual funds, but investing in fixed deposits is a strict no-no for a very long time. So that was my suggestion for you today, and we'll meet in next video. So thanks a lot.